this export armada out of China that reamassed, leading to a global hot rolled coil pricing death spiral, is basically exactly what happened. And we got to the very bottom of that death spiral about, give or take, 6 to 10 weeks ago, 6 to 8 weeks ago, late August, mid-September. And now a few things have happened that may pull us out of that death spiral condition, but a lot to be determined. So I went ahead and stole last year's, recycled, probably be the even more appropriate term for this industry nowadays, last year's title, and we're going to revisit it. My clicker is not working. Oh, here we go. Now it is. All right, so let's talk about what the heck is a death spiral anyway, a pricing death spiral. The way we define it is it's a period of time where the price is below the marginal cost of production. So marginal or variable cost of production. That's a pretty dire condition in any industry, in any commodity or product, you name it. When the price of your product is below its marginal cost. And the way we measure that, we look at the marginal cost of the median cost producer, that's the guy in the middle of the global cost curve, as sort of a representative point of reference for this analysis. So on the international market for hot rolled coil, and we use our World Steel Dynamics World Export Price, which is kind of an average price, FOB port of export from the major points of origin where flat rolled sheet products are sold. So think Japan, Korea, Turkey, India, Vietnam, Russia, and others as your major net exporters of these products globally. So this is kind of the average offering price, FOB port of export from all these points of origin against the average cost. And so if you look at where we've been in the past, roughly, call it 18 months, we're looking a lot like the 2015-16 global steel crisis, where, as we all probably remember, for those of you that were around the industry at that time, everybody was screaming and yelling that the world's coming to an end, steel companies are going to go bankrupt, and this cannot go on, we must do something about global overcapacity. The OECD created the Overcapacity Committee, and lots of things happened thereafter, yada yada. But the point being, numerically at least, where we've been for the past 18 months looks a heck of a lot like 2015-16. Now, it hasn't felt that way necessarily yet, for a variety of reasons, primarily being the trade suits, the trade actions that have been implemented since 2015-16 after that experience, so that have isolated many regional markets in a way that has allowed producers in those markets to sustain higher home market prices and maintain some level of profitability as opposed to being quickly pulled down into loss-making territory by what's happening in these international markets. Now, when you look at it from the perspective of China domestically, the situation is even worse. Again, if you look at those two red bubbles, one's the 2015-16 bubble, one's the current bubble, you can see just by the scale of the losses themselves, the dollar per ton amounts, and the duration of this loss-making period, it's much longer and much worse than it had been in 2015-16. So the situation in China is pretty much catastrophic. You can't mince words. I was there in April, attended one of their major domestic steel industry conferences, and listened to, for example, the chairman of CISA, the China Iron and Steel Association, essentially attempt to cajole those that were in the audience, majority of whom were producers, into producing less for the sake of the overall benefit of the industry, so that they're not going to lose as much money as they're losing today, and also, by the way, to maybe export a little less so as to not create another wave of trade suits against Chinese steel products and other products as well. So imploring the industry didn't do a whole lot in April. Why? Because it's an incredibly competitive market. There are, by some counts, 70, maybe now even 80 wide hot strip mills in the country, and quite simply, you cannot get them to stop producing through anything other than either market forces or some kind of a central government edict. And we'll talk more about all those forces and those edicts and what works and doesn't work in China. So all of this has led to what? We've had a prolonged period of downward trending steel prices all over the world, including here in the United States. Again, Adam will spend some time talking about that. But I think it's important also to point out, when you look at this chart, that to some degree, yes, we're experiencing a calamity similar to 2015-16 due to oversupply. That's certainly a big component of the price trend. But another one is that we're simply coming off an unsustainable high that was created during COVID. $1,100 a ton on the international market hot roll isn't something that happened ever before, nor would one expect that to be sustained long into the future, especially in an industry that can certainly respond to prices and profits at those levels with additional supply and respond pretty quickly. So to some degree, we're coming off an unsustainable high into a more normal period. The whipsaw of supply chain distortions, people chasing steel because of COVID, then subsequently the Russia-Ukraine war that started that caused a lot of panic in the international markets as well. Those things have all slowly faded into the background. Supply chains have been more or less restored to normal. Inventories have been right-sized to a much more stable level of demand now. Remember, during COVID, you had two things going on. You had demand signals that were wacky, and obviously, people were short of supply relative to those demand signals. Now demand signals have largely stabilized. Everybody understands what they need to have in inventory going forward, or the uncertainties with a much tighter range. So it's to be expected that prices would be coming down from these unsustainable highs, irrespective of what might be happening with respect to oversupply in China and everything that they're doing. Now, commensurate with the decline in steel prices, we've had a correction in raw materials. Coking coal is way off its prior highs. By some opinion, let's say current coking coal prices around 200 to 210 are essentially at the marginal, they're representative of the upper quadrant of production costs, so we're kind of at a resistance level for coking coal in the opinion of those I speak with in that industry. However, you've got some additional pressure both on supply and coking coal. There's new mines coming online next year, mining capacity expansion underway in Australia that's of a significant scale. And oh, by the way, in all of this, China has been boosting exports of coke. They're overproducing coke, much like they're overproducing steel, and they're exporting a lot more coke on the international market, as well as, for example, there's been some significant merchant coke capacity brought online in Indonesia to the tune of 5 million tons of merchant coke, which is a huge, huge amount in that market, which might only be about 10 to 20 million tons in a given year in terms of international merchant coke trade. And there's more to come. So there's a lot of pressure on coking coal. That's mostly to the downside. So we tend to view, let's say, coking coal as being relatively stable at current levels going forward. Any downside is going to incentivize buying from China, which, for example, is exactly what drove the price up from the bottom at 180 to about 210 today. The Chinese stepped in and saw clearly a rock bottom price arbitrage and began to buy again on the international markets. But at the same time, upside appears to be relatively capped. So something, of course, a black swan can always come along and send coking coal prices back toward $300 a ton. But at the moment, we don't necessarily see that in the foreseeable future, short of some crazy monsoon season in Australia and so on. So, long story short, coking coal has come down. Iron ore is also coming down, and iron ore is heavily tied into Chinese steel production. They're the biggest buyer of international iron ore. They're the price setter, and this, very difficult to read chart on the right basically puts supply, which is the green kind of stair-step line, relative to demand, which is the blue line. All right, and you can see anytime demand kind of dips below the supply line, the price of iron ore tends to go down. And that's the period we're in today, with Chinese steel production off about 4 or 5% this year versus last year, i.e. demand is down. They continue to push domestic ore pretty aggressively, their production of domestic ore, I should say. So iron ore prices are also under pressure. So that's good news in a world where steel prices are also under tremendous pressure. Unfortunately, up until about 8 weeks ago, the two weren't keeping up. In other words, iron ore wasn't raw materials weren't coming down faster than steel prices. It was the other way around. Margins were eroding, i.e. the charts we were looking at a few minutes ago. Which brings me to, all right, well, what at the end of the day drives steel prices internationally? What's the ultimate driver? And I think, confident I've shown this chart in front of this audience in the past, certainly have done it in other presentations, but when you look at it all through the immense complexity of the global steel industry, it kind of boils down to two things, and really one, which tends to dominate. We take the world, break it into two halves, China and everybody else, and we look at two things: demand growth outside of China and change in Chinese net exports. So how much China sends steel to the rest of the world year over year, relatively speaking. Does it go up? Does it go down? And how much does demand grow in the world outside of China? Does it go up and does it go down? So in most years, when China's net exports of steel go up, international steel prices go down. And that tends to be the dominant driver. Now, in some years where you have significant growth in Chinese exports and you have significant growth in non-Chinese demand, the price decline may not be that substantial, or it may actually be a small increase in price. Okay, but those are few and far between in this exercise. Most of the time, a growth in Chinese net exports yields to a significant decline in international prices, and vice versa. A big decline, or a decline, I should say, in Chinese net exports yields a pretty significant improvement in international steel prices. And the wild thing to me, and I've been around this industry for 20 years now, is that the entire thing, the thing point between a strong year of price growth and a year of price collapse is on the order of 15 to 30 million tons in a 1.9 billion ton industry. A swing on the margins of 30 million tons in this industry can be the difference between prices going up 30% year over year and prices collapsing to the marginal cost of production. And in effect, that's where we are today. What has happened, no big mystery here, is the surge in Chinese net exports, and you can see they're basically approaching what we saw in 15 and 16, where north of 100 million tons annualized, has increased that net export to the non-Chinese world by about 20 to 30 million tons over the past 18 to 24 months, sending international steel prices plummeting with all the accompanying losses that I just showed you a few minutes ago. From a production perspective, what it's meant is a fairly significant collapse in production in many parts of the world, especially the EU, where steelmaking is operating at about 60% of its most recent peak. So we're kind of, capacity is an elusive term, elusive metric in steel, in my opinion. You heard Rick allude to that earlier with pipe and tube. It's no different for flat rolled or anything else. So measuring where we are relative to some metric of capacity is kind of silly, in my opinion. What we do is we look at what was actually produced in times of extremely strong pricing and profitability. Right? That's a pretty good indication of what the system is capable of, because that's when producers tend to push output to, as close as they can to its capability. So when we compare that recent production peak to where we are today, we have some pretty dire circumstances in many parts of the world. Europe being at the forefront, advanced Asia, Japan, Korea, Taiwan being another. And in the world outside of China as a whole, we're sitting at about 87%. But if you exclude India, which has been about the only area of growth for steel demand and steel output in the non-Chinese world, figure gets a lot worse. We're about 18% below production capability, which means what at the end of the day? Which means a lack of pricing power from the steel mills perspective, right? When in Europe you're at 60% of what you can be producing, doesn't give you a whole lot of pricing power in your regional market with that amount of excess supply, available supply. And speaking of Europe, I mean, from a demand perspective, things have not been great. I'm sure you all know that from reading, just headlines in the Wall Street Journal or anywhere else. Economic conditions have not been good. Europe's not really rebounding from COVID the way that the U.S. has. And that trend essentially continues into today. Things like PMIs, sentiment indices, there was a little bit of an improvement late in the summer, and then it's all kind of fallen off a cliff as of late. There are some glimmers of hope, I would say, from what we track in Europe. Construction seems to be showing some signs of stabilization, maybe a little bit of a pickup. Automotive is hanging in there. It's probably going to see a better fourth quarter this year than maybe even last year, perhaps. And obviously, so those are the obvious interest rate sensitive sectors, right? And the ECB is starting to cut rates, so their rate cutting cycle is kicking in. So there's reason to believe at a minimum that Europe's bottomed out when it comes to steel demand over the course of this year. So next year we'll start to see some very modest growth, if not just flat, let's say year over year as opposed to another year of decline. So we're somewhat optimistic for Europe, but you can see, I mean, when we look at the producer margins in Europe in October, you can see what happened. We've had a pretty significant collapse from what was, several months of relatively decent profits, measured by, in our case, we measure it relative to pre-COVID levels, 18, 19 on average, adjusted for any kind of energy cost inflation, which is obviously an important factor. So net, October's been a tough month, and that's probably the bottom of this death spiral that we're talking about. Why? Well, because of the China stimulus. So I'm sure all of you have seen in the news in some form or another, China announced a massive stimulus program, very much unexpectedly late in September, and the market surged. Okay, so we came off the bottom where the Chinese export price of hot roll was anywhere from $420 to $440 a ton FOB portable export. It surged by about $100 all the way up to $540, although from our understanding, no one actually transacted at those numbers, but those were the representative, let's say, offer prices. Nobody actually hit the bid on that number. But nevertheless, on sentiment alone, the price surged by about $100 a ton out of China, and similarly on the international markets over the course of the last week of September through up until about a handful of days ago. And up until then, we were discovering what this stimulus is all about. And so there was a lot of hope that this stimulus would become what's called level 3 stimulus, and it would allow the Chinese property sector, which had been the major driver of decline in Chinese steel demand, to sort of hit bottom and start to improve. What's emerging over the last handful of days is essentially a dynamic where the stimulus is once again probably disappointing from the steel system perspective. What it's going to largely be focused on is bailing out local governments and local government finances. Why is that important? Well, because the local governments were generating upwards of 30-40% of revenues from land sales to property developers, which collapsed. Their financial position collapsed. They weren't paying their bills. They weren't paying contractors. They weren't paying government workers. That was all impacting consumption, confidence, all of the above. It was also impacting infrastructure, which had been the primary driver of steel demand. It was acting as an offset to the steel demand that was being lost from property activity. So that came under pressure during the third quarter, especially this year. So the whole system was beginning to kind of implode, both from an economic but also a steel perspective. So what we think has just happened is basically the following. They've more or less announced relatively concretely a program by which they will bail out the local government finances. And have been signaled that, yes, there may be some help, more help to come for property, but it's highly undefined. So what we think that's going to lead to at a minimum is two things. One, it will lead to an improvement in infrastructure spending, which had slowed greatly during the third quarter. And we're beginning to see some of that in that bottom right-hand chart, which shows the issuance of local government bonds, which are in turn used to finance infrastructure projects. So that surged in August, September, actually even before the stimulus. Now, in theory, you've recapitalized local governments, or you will, and they will therefore spend more aggressively next year, let's say, on infrastructure. Meanwhile, property will continue to bottom out. So the net good news might be that instead of declining by about 5% this year, Chinese steel demand next year might only fall, let's say, a fraction of a percentage point, give or take, which would also hopefully lead to a year-over-year decline in Chinese net steel exports, which, remember, is by far and away the most important thing for international steel prices, as we pointed out. So we're penciling in a modest 15 million ton decline in Chinese net exports, which allows, even in an anemic growth year for non-Chinese steel demand, which we're projecting at only about a percentage point, a pretty healthy year of steel production growth at almost 3%, creating a little more pricing power for the producers outside of China and pulling the entire system out of its death spiral. So that, in a nutshell, is what we forecast in for the moment, pending new revelations from China that would lead us to new conclusions, which is, of course, something that could happen